Welcome to the Riskwiser Zone, the podcast where we dive into the world of finance and explore the latest trends, insights, and expert opinions. I'm your host, Louis, and I'm excited to have you join us today. As we kick off this episode, we're going to talk about an asset class that's often perceived as a safe haven, gold. But is it really as risk-free as many investors think? A recent article caught my attention which analyzed the past 15-year price data of gold and compared it to equities. The results might surprise you. According to the data, gold has delivered an annualized return of 10.73% over the past 15 years, which is lower than the 12.49% return from equities. And if we look at the 5-year period ending March 2025, gold's return of 14.03% is significantly lower than the 26.23% return from equities. But what about downside risk? The maximum drawdown for gold investors over the past 15 years was 29.47%, which is substantial. In comparison, the maximum drawdown in equities was 38.11% during the COVID-19 pandemic. So, while gold may be less volatile than equities, it's not entirely immune to market fluctuation. The article also highlights the importance of correlation between asset classes. Interestingly, there's a negative correlation between equities and gold, which makes it an attractive asset class for diversification purposes. This can help reduce overall portfolio volatility and improve risk-adjusted performance. So, what does this mean for investors? While gold is often seen as a safe haven, it's essential to understand that it's not without risk. However, its negative correlation with equities makes it a valuable addition to a diversified portfolio. As we explore the world of finance, it's crucial to consider multiple perspectives and stay informed about market trends. We'll continue to examine the intricacies of gold and other asset classes in future episodes. For now, let's take a break. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and investments, where the stakes are high and the rewards can be substantial. Today, we're discussing the Indian market, specifically focusing on Ather Energy's initial public offering. This electric two-wheeler manufacturer has been making waves in the industry with its innovative products and strong growth potential. Now, let's delve into the details of the IPO. The issue size is approximately Rs 3,000 crore, comprising a fresh issue worth Rs 2,626 crore and an offer for sale of Rs 355 crore. At the upper price band of Rs 321, Ather Energy is valued at around $1.4 billion. This valuation has sparked debate among analysts, with some considering it expensive and others viewing it as a reasonable price for a company with strong growth prospects. The subscription status of the IPO has been a topic of interest, with retail investors showing consistent demand, subscribing 1.55 times their allotted quota. However, non-institutional investors and qualified institutional buyers have been more cautious, with NIAs subscribing to only 36% of their portion and KIBs, showing stronger interest in the final stretch. The gray market premium for Ather Energy's unlisted shares has been declining, currently trading at Rs 322, just RE above the upper end of the price band. This reflects a negligible premium of 0.31%. Analysts have mixed views on the valuation, with some recommending a subscribe rating for high-risk investors with a long-term view, while others suggest applying for listing gains. It's essential to consider multiple perspectives when evaluating investment opportunities. Ather Energy's pioneering position in the electric two-wheeler segment and its strong growth phase are positive. However, the current market sentiment and valuation concerns should also be taken into account. As we navigate the complex world of investments, it's crucial to stay informed and adapt to changing market conditions. We'll continue to monitor Ather Energy's IPO and provide updates on its performance. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've had a fantastic discussion so far, covering various aspects of risk management and investment strategies. As we approach the closing segment of our show, I'd like to shift our focus to some recent developments in the financial world. We've been following the story of IndusInd Bank, which has been making headlines due to its leadership crisis. The bank's board has been facing challenges, and the Reserve Bank of India has been closely monitoring the situation. According to Ashwin Parekh, a renowned expert in the field, the bank needs a new leader who can provide stability and reassurance to stakeholders. Parekh suggests that appointing an interim CEO might not be the best solution, as it may only provide temporary relief. Instead, he recommends that the bank's board should focus on selecting a full-fledged leader who can take the bank forward in the long term. This new leader will have the opportunity to reshape the bank's strategy and direction, which could potentially lead to positive changes. It's also worth noting that the RBI has the option to nominate a director to the bank's board, but Parekh believes that this might not be the most effective solution. He thinks that having a strong and capable leader at the helm is more crucial for the bank's success. As investors, it's essential to stay informed about such developments and consider their potential impact on our portfolios. We should always be cautious and adapt to changing circumstances in the market. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.